A mochi moment from Mark, who writes, I just want to thank you for making GLP-1s affordable. What would have been over $1,000 a month is just $99 a month with Mochi. Money shouldn't be a barrier to healthy weight. 3 months in, and I have smaller jeans and a bigger wallet. You're the best. Thanks, Mark. I'm Myra Ahmed, founder of Mochi Health. To find your Mochi moment, visit joinmochi.com.
Mark is a Mochi member compensated for his story.
This podcast is supported by MIDI Health. Are you in midlife, feeling dismissed, unheard, or just plain tired of the old healthcare system? You're not alone. In fact, even today, 75% of women seeking care for menopause and perimenopause issues are left entirely untreated. But it's time for a change. It's time for MIDI. MIDI's not just a healthcare provider. It's a women's telehealth clinic founded and supported by world-class leaders in women's health. Their clinicians provide one-on-one, face-to-face consultations where they truly listen to your unique needs. They offer a full range of holistic, data-driven solutions that isn't one-size-fits-all care. This is care uniquely tailored for you. At MIDI, you will find that their mission is clear: to help all women thrive in midlife, giving them access to the healthcare they deserve. Because they believe midlife isn't the middle at all. It is the beginning of your second act. Ready to feel your best and write your second act script? Visit joinmidi.com today to book your personalized, insurance-covered virtual visit. That's joinmidi.com. MIDI, the care women deserve.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, Texas State Representative and author of the book Wealth Warrior. All right, Investies. I don't know how I'm going to make it through this episode, but I am going to do my best. I, of course, watched the Benito Bowl last night. What an absolutely incredible performance. It made us all so emotional to watch. It was one of the most rich and beautiful performances the Super Bowl has ever seen. Last night was for the culture. We needed that. He said so much without saying what he needed to say. And we felt it. And it made me so proud, and it also reminded me of how much we contribute to the United States of America. There's so much depth to everything we share. I mean, all I know is the culture needed that last night. It was incredible. He won, hands down, the best performance ever. The pink casita with all of the Latino gang present. Okay, let's talk about why we are here today. And I'm going to, as I mentioned, do my absolute best to get through this and then go deal with my headache. The Dow last week was up by 1.3%, which is, really great for the Dow. The S&P was down 0.10%, and the NASDAQ was down 2.15%. So we definitely have a mixed bag there. It's really important for us to understand that the Dow is a price-weighted index, which means that it is measured based on price movements. So it doesn't rely on market capitalization. It relies on the price of the actual stock. This is a very outdated method on how to review the Dow, or not the Dow, but how to review the market in general. So it's really important for us to take the Dow with a grain of salt. If anything, we use the Dow to measure if people are moving from one sector to another. That is all we use the Dow for. We don't look at it and be like, oh, the market performed great last week because it was up 1.3%. No, we don't use the Dow like that. The Dow is just alerting us that there is movement taking place in the market. Now, the S&P and the NASDAQ, those are market capitalization weighted. And that tells us the increase in how much the company is worth. So when it drops in value, it goes down. And when it increases in value, it goes up. It meaning the index. It is not based on how much the price of the stock goes up and down. Also, the Dow is only measuring 30 publicly traded companies. The S&P is measuring 500, and the NASDAQ is measuring thousands. Okay? So take the Dow's decrease or increase with a grain of salt. It is not reflecting the actual economic reality of the situation. I know these things get confusing, but that's what we're here for, to help you understand. Let's get into why the indexes didn't perform as great. Again, the S&P negative 0.10% and the NASDAQ 2.15%. We're almost always going to see the NASDAQ be much more volatile than the S&P 500. That's because we have more volatile stocks in that index, all of the big tech. Now, we did have the remaining two companies in the Magnificent Seven report last week. That was Amazon and Alphabet. And it looks like there was the return of the narrative that was a big threat over the summer. I'm not sure if you remember, but over the summer, we were pretty much moving down consistently because of the capital expenditures that felt really unexpected from the big tech companies. That narrative returned last week with Amazon and Alphabet. Capital expenditures, or CapEx, is money that a company spends to buy, upgrade, or maintain long-term assets that will be used over multiple years, not day-to-day expenses. So a lot of the CapEx that is being reported is to build out the AI infrastructure. This is proving to be more costly than anticipated, mostly because there was so much hype pertaining to AI, the implementation of AI into all of these tech companies. And as we know, the stock market went bonkers over this, and we saw surges in all of the tech companies. And then we started questioning the market value of these companies if they were overpriced. The CapEx expenditures is kind of saying, yeah, maybe it is overpriced because we still have to build out the infrastructure for this. Last week, we saw the CapEx narrative return. Alphabet did beat earnings and revenue. Earnings per share came in at $2.82 versus what analysts were expecting, $2.63. Revenue came in at $113.83 billion versus what analysts were expecting, $111.43 billion. Now, for their Google Cloud, they also beat analysts' expectations, reporting $17.66 billion versus $16.18 billion expected from analysts. YouTube advertising, they did not do as great. They reported $11.38 billion versus the $11.84 billion that analysts expected. It did not matter that they beat the expectations for the top line and the bottom line, also known as earnings per share and revenue. They definitely got punished for their capital expenditures. Alphabet is expecting to spend a significant amount on CapEx in 2026. CEO Sundar Pichai said, "As we scale, we are getting dramatically more efficient. We were able to lower Gemini serving unit costs by 78% over 2025 through model optimizations, efficiency, and utilization improvements." He's trying to defend the amount that is going to be invested into the infrastructure of AI and talking about how great their investment was for 2025. However, that was not enough. We saw the stock immediately drop 5%. It did somewhat recover the following day. It is currently down 6.27% from its all-time high. However, it is up 71% from the last 12 months. Amazon missed earnings and beat revenue. Earnings for Amazon came in at $1.95 per share versus what analysts expected at $1.97 per share. The revenue came in at $213.39 billion versus $211.33 billion expected from analysts. On their line item for Amazon Web Services, they also beat analysts' expectations, coming in at $35.58 billion versus $34.93 billion. Advertising for Amazon was also a beat, coming in at $21.32 billion versus what analysts were expecting at $21.16 billion. CEO Andy Jassy said, "With such strong demand for our existing offerings and seminal opportunities like AI chips, robotics, low Earth orbit satellites, we expect to invest about $200 billion in capital expenditures across Amazon in 2026 and anticipate strong long-term return on invested capital." Well, the market was very unhappy with Amazon's miss on their earnings and, of course, with a $200 billion expenditure expected in 2026. The stock immediately dropped 8%. Amazon is down 17.09% from their all-time high. And if we look at their last 12 months, they are down 11.36%. So you can see the drastic contrast there between Google being up 71% and Amazon being down 11% for the last 12 months. Sometimes this happens in your investment, and it is important to remain obviously patient, making sure that you're listening to earnings and understanding why they are not performing as expected. The stock in and of itself being down is definitely not a reason to sell. You have to understand why the stock is down and then use your best judgment on whether or not you think they can recover from being down. So it is important to get to know your investments so that you can properly discern. We also had employment data that came in for the month of December. The job openings data that is produced by JOLTS, U.S. labor data. This helps measure job vacancies. JOLTS stands for Job Openings and Labor Turnover Survey. So we were expecting for job openings to be at 7.2 million. However, actual job openings came in at 6.5 million. Last month, job openings were at 6.9 million. This is a drastic drop. I know that millions of job openings feels like a lot, but when we actually measure this against levels throughout history, this is a level that was most commonly seen during COVID. So numbers came in lower than analysts' expectations, which tells us that things are a little worse than what we thought.
Close your eyes. Listen to Monday.com. Feel the sensation of an AI work platform. So flexible and intuitive, it feels like it was built just for you. Now open your eyes, go to Monday.com, start for free, and finally breathe.
This episode is brought to you by Progressive Insurance. Fiscally responsible, financial geniuses, monetary magicians. These are things people say about drivers who switch their car insurance to Progressive and save hundreds. Visit Progressive.com to see if you could save. Progressive Casualty Insurance Company and Affiliates. Potential savings will vary. Not available in all states or situations.
We also got the November ADP report. This also fell short from expectations. This one was actually relatively bad. ADP stands for Automatic Data Processing, and this report is produced with Stanford Lab. It reports how many jobs were added from the private sector. This is one of my favorite reports to look at because a lot of you all may be familiar with ADP. It is a processing payroll system and human services software that a lot of companies use. The actual jobs added number came in at 22,000. Now, what analysts were expecting was 46,000. So you can see that that is a relatively significant drop, especially when we look at what was forecasted by analysts. And in the previous month, there was 37,000 jobs added. So again, we're looking at a trend where these numbers are decreasing. The number would have been even worse, except for there was a surge in education and health services, which kind of helped soften the blow. Otherwise, the number would have come in negative. All right, we have one more job report that was released. Now, this job report is a report that we've never really paid attention to in the way that the media is paying attention to now. This is the Challenger Gray and Christmas report. We actually relied heavily on this report during the government shutdown, and it looks like the media is going to start to really pay attention to this report in addition to all of the other reports that come out, which I think is a positive thing because, as I've mentioned before on this podcast, I do feel that the way the government is measuring job openings is really, really outdated. Now, this report was created back in 2009 when we saw the financial crisis take place. They did release some alarming numbers. They announced that we had 108,000 layoffs for the month of January. This is up 118% from the same period a year ago. So January of 2025, those layoffs are up 118%. And if we compare this from just the month prior in December of 2025, we are looking at a 205% increase, okay? The last time we had these numbers was during the financial crisis at its lowest point. And the time before that was during the Great Depression. Investies, it is so important that we pay attention to what is taking place in the economy. I understand that this information is so dense and it is not easy to process, and it can be overwhelming and also cause stress. But I think it's important for us to be aware of what is taking place so that we can act accordingly. Not to mention that we currently have an administration that is gaslighting us with what is actually taking place. And you have an entire cohort of people that believe what the administration is saying about the economy. It is time for us to empower ourselves with knowledge and understanding. And I know these resources haven't been made accessible. We try to make it as accessible as possible here on Investies podcast. We try to do it in a short period of time weekly so that it doesn't, overwhelm your day. And I try to make it as easy as possible. I just want to say that I think it's awesome that you're here and that you're learning alongside me. Thank you so much for supporting this podcast. If you find it beneficial, please head over to the podcast application, rate and review us. I posted these numbers of the Challenger Gray and Christmas report over on our Instagram account at Investies Podcast. Follow us there. And I was mind blown by how much people will defend something that they do not fully understand. And that is not their fault. That is the school system's fault for not giving us the proper education on financial literacy and the economy as a whole, something that we are all dependent on. It just blows my mind. And so I just kind of want to say, I'm proud of us for showing up and being here on a weekly basis and doing our best to understand a system that has kept us out for so long. Thank you for tuning into Investies podcast, a Cosmic Standard production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.
This is a Monday.com ad. The same Monday.com designed for every team. The same Monday.com with built-in AI, scaling your work from day one. The same Monday.com with an easy and intuitive setup. Go to Monday.com and try it for free.